Okay, well, hello and welcome everybody. David has been kind enough to ask me to speak at one of his broadcasts again today, and as he mentioned, that we have a history that goes back a ways, and it's really exciting to see how his business and his educational process has flourished. And it's always exciting for me to come back after a period of time and see what traders are interested in and what they're looking at and what they're valuing, what's their focus, that kind of thing. And it's good to see that that's evolving from what I can see so far. My name is Jason Allen Jankovsky, and I'm going to go ahead and take a few minutes and introduce you to some psychology that I think is going to challenge the way that you perceive yourself and the way that you perceive the markets, possibly encourage you to consider changing things about your perceptions and how you approach your behavior on a daily basis. For those of you that aren't real familiar with who I am and what I do, I want to take just a brief minute and introduce myself. But before I do that, I need to do one quick thing here, and that is make sure we're all on the same page. For those of you that may be new, because we don't know, of course, who's listening, there's always the possibility of loss. Trading is not for everyone at all points in time. You can lose some or all of your investment, in rare cases, maybe more. So you need to carefully consider if trading in the markets is really something that is suitable for you in light of your tolerance for risk and your emotional tolerance for risk as well. Everything that we talk about in here is opinion, market data. That's all trade discussions. That's all subject to change at any time. So what we want to do today is introduce you to a new point of view. And now that the regulators are happy, I can go ahead and get right to work on that. But I want to tell you a little bit about me so you understand that what I'm going to share with you really is heavily vetted. Most people who do education, training, and all the rest, they haven't been through the kind of background that you might think they have been through, or that would really make a quality trader. And I'm going to challenge you to do a little bit of homework on that. And the important thing for me to educate you on about me, to give you a heads up right away, is that I'm self-taught, self-educated as a trader. I went to work. I did my very first trade in Chicago Board of Trade, big board corn, in 1986. I started as a customer, just like you. I opened my first trading account, probably never heard of the company, Jack Carl Futures in downtown Chicago, where I was born and raised. And I was absolutely 1000% hooked. I knew this is what I wanted to do. I was a young man at the time, had been successful in a couple of different career choices up to that point. And I said, this is what I want to do. And so I decided to get into the markets, and I got into them full time in 1987 as a Series 3 registered broker / trader. And I trade my own money every day. I train and coach other self-directed traders. I've been doing that since 1997. I have 4 books published, 3 of them by Wiley & Sons. 1 is self-published. The self-published book is what I'm going to introduce you to at the end of the broadcast today. And I'm going to ask you to get a copy. It's probably going to be the best $10 you'll ever spend on education and training for yourself. Regular guest speaker at many trading events like this. And additionally, it's important that you understand my focus, which is not about educating you, but it's to train you differently. It's to teach you something which basically is similar to the relationship between fishing and eating. If you give a man a fish, he'll eat for a day. If you teach him to fish, he'll eat for a lifetime. And that is something that is really, really important for you as a trader to understand, is that what you think trading is really all about is not what it's really all about. And part of the reason why you have losses, and part of the reason why you're getting your rear end kicked most of the time, you don't know why, and you can't figure it out. And if you're honest with yourself and with me, because you need to be, you know that you have losses on a regular basis, and you don't know where they come from or why they happen. Because all that is occurring to you, you and I both know that that's a solvable problem, but you don't know where to go to solve it. So my focus is on the effect to change your thinking from studying the markets to how you use the markets. Trading is not what you think it is. And that's what we're going to talk a little bit about today. And hopefully this will stimulate a little bit of discussion. I hope that's the case, because it's going to be really hard for me to fit a lifetime of experience into 55 minutes, but I'm really going to try. All right, so moving on. Every trader has to learn to trade. You're not born with the ability to do this. You have to learn. And this process, it's not unique. Everybody has to do that. And to succeed at anything, you have to have a learning process, an understanding process, what needs to be done for success in that particular field. Somebody hands you a baseball and throws, it tells you to throw the ball and strike this guy out. It takes time to learn how to do that. You got to know what to do, what not to do, how to avoid certain things. What's the learning curve on how to become a great baseball pitcher or great baseball hitter, slugger? Anyone who's succeeded at something, doesn't mean what it, I don't care what it is. It doesn't matter what it is. Whatever you learn to succeed at, if that happened for somebody, then that means it can be done by anybody else too. We all share the same body, the same nervous system, the same perception ability, and the same rational cognitive approach to our mental process. Now, all of that might need to be fine-tuned, and some stuff needs to be eradicated, and other stuff needs to be trained and disciplined. But the bottom line is, if somebody learned how to run a 4-minute mile, and if you have a sound, healthy body and quality approach to learning how to run, you can attempt to try to run a 4-minute mile. And that's how Roger Bannister did it. He was a doctor. He studied other athletes until he figured out what had to happen to run a 4-minute mile. Now, everybody, if you can't run a 4-minute mile, you're not competitive, right? If someone has done something, made $1 million trading and did it in 90 days, you could learn to do it too. You might be surprised what has to change to be there, but it's a learnable skill. But more importantly, what causes someone to lose? Because without that knowledge, you can't learn what to avoid on your way to that strong performance pathway. So if we look at people that have failed at something, all losers, people that failed at something they believe they could succeed at, they share common traits, common behaviors. And those similarities are common to every other person as well. In other words, no matter what you and I wish to succeed at, we're going to share the same experience and the same issues to get there. That's why when a bunch of people that have all been through something together sit down to reminisce, they all say, oh yeah, that happened to me. Oh yeah, that's what I experienced. I had the same type of thing. I remember that, because it's the same process for everyone. Failure, same thing. It's the exact same process. Why do we all fail the same way? We've all done the same thing. You've all held a winner and let it turn into a loser. You've all held a trade past the best possible point to exit. You put a trade on, the market went against you instantly, stopped you out, and then ran away. Would have made a fortune, but you weren't in. Everybody's had all the same experiences. There's no new experience in the marketplace. Everybody's got the same process. But the reason a loser loses is because certain things are going on inside of the loser continually. First of all, the first thing is he doesn't know what he doesn't know. So you think the problem isn't you. You think the problem has to do with something else. It's external to you. It's knowledge, understanding, training, if only. I need more of X, not Y, blah, blah, blah. That's all the illusion that we're going to talk about today that prevents you from getting the real help you need to win. So you think the problem isn't you. That's part of why people lose. Failure at anything is the same for anyone. Losers fail in the markets for the same reasons anyone fails at anything else. They're either ignorant of what is causing their failure. They just simply don't know what they don't know. They're ignorant of what's causing failure, or are unwilling to make the needed changes required. When confronted with here's why you're losing, they don't believe that. They're not going to make that change. Or, in most cases, it's a combination of both to some degree. My experience has shown me in all the training and education I've done, it's a combination of both. There's a lot of people out there that have got tons of ignorance. They don't know they have it. And then when they're confronted with it, they don't want to make those changes. So I've experienced all that. But losing in many ways, this is my opinion now. A lot of people don't agree with this, but this is my opinion. Losing in many ways is a choice. A proactive individual will see that they need to learn something whereas a loser won't do that. Losers make excuses, justifications. In fact, all the stuff losers do, we're going to talk about in just a minute. Losers make excuses, justifications, etc., all that stuff, and or they become confused as to what specifically must change. Now, if you want a real education in confusion, you want to read my second book, The Art of the Trade. If you one of those people out there that have read it, thank you. If you haven't, it's a real eye-opener as to what not to do. But one of the things that's really intriguing is that I brought to the table a failure in understanding. I didn't know what it was specifically that had to change. And so I got my head kicked in for years and years until I had an epiphany understanding. Something, the light went on for me and I never looked back. That process is how I became a winning trader. Not everybody will go through that. But the important thing here is this. I became confused as to what specifically had to change. And when I got clear on that, I instantly made that change. I wasn't going to wait. Now, why do losers in the markets fail? So what are the similarities between losers and losers in the market? They're typically expressed in the markets as certain choices and certain behaviors. Market losers will operate with similar methods of thinking, and they express this thinking as where and when they buy and sell in the market. In other words, they think a certain way, that becomes their buys and sells. Do you follow me? Now, remember I told you I can't, in a 55-minute presentation, give you the exact process of how that happens. I'm going to give you the highlights. If I think a certain way, I'm going to buy or sell at a certain place in the market, and those certain places are almost always the wrong places to do it, which means most people make profit by accident. And what happens next? They can't duplicate winning behavior because they don't know how they made it to begin with. Therefore, they're more confused when they lose, because if they did A, accurate, and it made a profit in the market, now they do what they think is the exact same set of behaviors and it results in a loss. They can't understand why that happened. So now they think they've got to do more research and study, when in fact, the whole premise of what they're doing is flawed to begin with, but they don't know that. One of the things that you'll find out to be true once you get to the point of being able to be a consistent net winner is that traders have 100% control over the net result in their accounts. 100% control over that. Nobody tells you when to buy or sell except you. Now, if you don't have control over that process because your greed determines your entry, your fear determines your exit, that's a different issue. But nobody is going to twist your arm and say, push the button now and execute. No, you have control over when you click the mouse. You determine what your results are going to be. Whether you believe those control exists for you or not, that's the control you have. But most people, most losing traders, feel they have little or no control because they've got to make money now and they don't know how to do that. And so when something happens, they've got to execute. They don't know how to do that though. So this feeling of low control, that's the result of their loser thinking. Their belief that gaining better control result in reducing the risk. Now, it's real important to understand losing traders, one of the behaviors they have is that they believe they can reduce the risk. They believe whatever it is that you define in the marketplace as risk, we can reduce that. And that, of course, is an illusion. You can't reduce the risk. Why can't I reduce the risk? People always ask me all the time, what do you mean I can't reduce the risk? What's all this study and all this crap all about? You can't reduce the risk because you live in a zero-sum environment. And I need to take a minute on this because this is going to really boil this down for people in a way that you probably have never heard. And that's not bad. It just means you need to wake up. And here's the bottom line. A zero-sum transaction is how all the markets work. Futures, Forex, options, warrants, they all operate in a zero-sum transaction. That means if I enter a buy order to get into the market today on the buy side, I think the price of euro is going to go higher. So I want to be long, so I enter a buy order. In order for that order to get filled, there has to be somebody else entering a sell order. Now, how can it be that two people with access to the same exact information, all the same reports, all the same charts, the chart of the euro on my screen looks the same as yours, All the same indicators and oscillators, all the same. Everything is identical no matter where you look at it anywhere in the world. We all know when the ECB is talking. We all know when the report's coming out as to inflation. All that crap is out there. And I think it's time to buy at the exact same time you think it's time to sell. So how do two reasonably intelligent people come to equal yet opposite conclusions? I think it's time to buy, so I'm going to get in on the long side, and you think it's time to sell. And we've done that by looking at the same shared data. That's the problem with shared data. I talk about this in my book, Psychology of Trading, is that shared data is why people lose. Because the data is the same for everybody. It's what you think it means to you is what's causing you to execute. So when you execute, you put an order in. When you put an order in, somebody else has to match that order. At that particular moment, it is now physically impossible for both of you to win. The only way you can make money in this business is if you take it from a loser. In other words, if I buy the market and you sold it to me, and the next round of orders comes in and it's large on the buy side, the market will move higher. As it's doing that, it's putting an open trade profit in my account, and it's putting an open trade loss in your account. Well, when it comes time for me to close my trade, my profit is coming from your account. So how do I make money trading? I make money trading by taking it from a loser. That's how money's made in this business. There's no other way to do it. There's no other discussion you could make. There's no other analysis you could make. There's nothing else you can do in this field for profitability other than take that money from a losing trader who's on the wrong side of the order flow. That's the only way to profit. So if that's the only way to profit, what is it that we really need if we're going to make money? We need to know where the loser is. That's it. That's all we need to do. If I want to make money, I need to know who's selling, because at some point they're going to be wrong and it's time for me to buy against those sell orders. If I want to make money on the sell side, I need to know which losers are buying, because when they're done and the market crushes itself, I'll profit. That's how money's made. Every buy equals a sell. Now, here's how you can't reduce that risk. Because the only way to make money is if I'm on the right side of the order flow. If I'm on the wrong side of the order flow, I lose. That's it. There's no discussion. There's only one way to do this. So if all of your research, analysis, study, training, education, whatever it is that you're putting all your time and 12 hours a day into, if it's not designed to help you find where the losing trader is, you're wasting your time. And I'm going to show you what that looks like right now. See, here's why you can't reduce the risk. Because how are you going to know what the order flow is until the order flow comes on? I've been trading for almost 40 years, and I still have losing trades. If it was all about education and experience, I've seen everything. There's nothing I haven't seen in this business. Nothing. That would be about, I should be at 100% winners by now, right? It's not about study, because people who study the markets can still have losing trades. If you're on the wrong side of the order flow, you lose. You can't tell what the order flow is. You don't know what the order flow is going to be, because you don't know what the orders are until someone places them. So how are you going to reduce that risk? How are you going to reduce the risk? How are you going to look into the world currency markets or the global gold market or the world crude market and look at all the millions of people doing this from moment to moment, second to second, and count the number of orders they're willing to place? How are you think you're going to get access to that data? Are you out of your mind? The European Central Bank wishes it could get better execution. So does the Fed. It's an illusion if you think you can study these markets to win. You can't. It's not going to happen. That's part of the reason why you lose. You can't reduce the risk. So what does that look like? What are the similarities? What do the losing traders do to try to reduce the risk? But they don't know they can't reduce the risk because they don't know they're in a zero-sum environment. Or even if they do know, they don't really know what that means. Like I just told you, you can't win unless you take the money from another trader. So unless you're studying your opponent and knowing what he's doing, you don't have a chance. The losing trader doesn't want to believe that. He wants to believe it's all about this stuff. Study and markets analysis and moving average crossovers and all that. stuff, right? This is what the loser has in his mind right here. Evaluations, assumptions, misconceptions or illusions, justifications, expectations, exceptions, excuses. These are only the first six. It goes on to other things: anger, fear, greed, hope. Anything that goes on in your mind is why you can't win. It's there. It's determining why you buy or sell. All these loser thinking patterns result in buy-sell choices which attempt to reduce the risk, which is the market term losing traders use for gaining better control. But you can't gain any control over the market, and you can't gain any ability to reduce the risk. It's never going to happen. So when we talk about evaluations, what's going on? Every losing trader brings to the table this issue as some form of market study. They all think technical analysis is going to be able to provide them a way of finding out what the market's going to do. They can reduce the risk by analyzing previous prices, combining and dividing prices and all the rest, moving averages and Williams percent R and Andrews pitchfork and the this method and the delta quadrant method and all. It doesn't matter what it is. It's all the same BS. I'm going to study my way to a fortune. It's an evaluation. The market, I'm evaluating the market. Well, it doesn't work. You and I both know that you can evaluate the market all day long, and it hasn't made a dime for you, has it? In fact, if you study technical analysis, like I've studied technical analysis, what you're going to find is that it doesn't matter what the analysis is. It's rarely better than 52% of the time. That means it's no better than chance. You can flip a coin and do 52% winning trades. Why don't you do that? Instead of trusting overbought, oversold indicators and moving average convergence and divergence, half the time you do that, you lose. If half the time if I was a shirt maker on Savile Row and half my shirts lost half their buttons all the time, I would have no customers. If I built cars that broke down half the time, I'd be a British car company, right? Nobody buys Triumphs anymore. Have you seen one lately? Why do you, if something loses half the time, which in the real world is an unacceptable ratio, if my computer broke down half the time, I would never use it. Why do you trust some method of analysis that's never better than chance? It doesn't work half the time. Why are you putting 100% of your trust and confidence behind it? Because those half of your losses are avoidable. Why is that? Assumptions. Traders tend to make assumptions about meaning. What does it mean? Market news. Well, news is coming out. I think the market's bullish. Bullish piece of news should drive the market higher. Market news. Price reaching a certain important, significant higher low point, right? Back testing a new system. Some new method of TA, something nobody's ever seen before, right? What's the latest thing? Neural net, open node, artificial intelligence. My software thinks at a 7-year-old level. I'm going to kill it. Really, 7-year-old level? Let me give my 7-year-old nephew $100 million. See how he does, right? Assumptions are made by losers because they believe that certain things are facts. And if it's a fact, it's true, right? That'll gain a sense of certainty because I can't do something unless I know for sure it's going to work my way. And that's the whole concept of waiting for confirmation. Market makes a low print. Your system says it's time to buy, but you don't buy. You got to wait for confirmation. So after the market moves in your favor, several $100s per contract, now you decide to buy. And what does it do? First thing it does, sells off, tags out your stop, and then goes. Yeah, gee, why? I waited for confirmation. Why didn't the trade work? Because you can't wait for, waiting for confirmation is an emotional need that says, I can't do the right thing for myself now. I need to have confidence that it's okay to do it. That's an emotional problem you have, waiting for confirmation. That's an assumption that price action moves one way that's definable and you can know what it is, but you can't. That's reducing the risk. You can't reduce the risk. Misconceptions or illusions. This is things like conclusion-making process about the meaning of prices, right? And these come out as things like should, and must, can't. The price should do X. If it does that, that's what should happen. And that's the way. It can't go higher, can't go lower from there. Market shouldn't do this, shouldn't do that. So for example, if a market moves to a certain price level, that's what should have happened. Therefore, the analysis I did was accurate. Therefore, I can trust that analysis moving forward. So the next time the market makes a low print and bounces, and I decide to buy by doing the exact same analysis that made me a profit on the last time I did a long trade that way. Now the market sells off hard. Why wasn't I short? I don't know. What was the illusion? I made an assumption about my study that was an illusion. There wasn't any way to reduce the risk. There's no way to fully, in other words, you believe something was accurate, so you trusted it a second time. If it didn't work that time, then there's something wrong with your analysis, so you have to go back and do better analysis, which is what? An illusion. Justifications. Every trader losing traders must evaluate. Losing traders are really big on this. They have to explain their losses. And this is just another expression of the illusion belief the process that they have, that prices can be predicted. See, if the market went the wrong way, quote unquote, that loss could have been prevented somehow. My analysis could have been done better. So I missed something. So I have to explain that. Everything was going fine on that trade, and then Janet Yellen came out and said something she wasn't supposed to say. Markets went haywire. You know what I'm saying? So that's somebody else caused that loss. That's how that happened. See, the critical factor in this thinking is that the focus of the justification is always outside of the trader. I analyzed the charts wrong. Charts are the problem. So-and-so said something. News was a surprise. So since the trader is still doing the same thing, he's trying to gain more control, reduce the risk, get better at this, and the loss happened because of something there was no control over, well, then that explains it. That's not my fault. That's just trading. Fault's not with the trader. It's just the way it is. Expectations. This is especially dangerous for a losing trader. It's especially dangerous to the losing trader because once an expectation is held in the mind, very little other data will be considered or absorbed. In other words, once a guy believes something is supposed to be a certain way, then that expectation moving forward flavors everything they do. Putting confidence in something that maybe he's not completely understanding, and expectations will create bias. So if you believe the markets are bullish and a piece of news comes out, you're going to look for the bullish argument in that news. Maybe you might ignore the bearish side, which had better probabilities, but you come to the table with an expectation of something happening. And then when it doesn't happen, you get upset. You can't figure out why, because that market potential should have been something else. Real common problem with this is when people look at things that are, quote, new. So when you buy a new trading system, something that's been heavily back tested, and it's got all this residual stuff that tells us how wonderful it is, you have an expectation it's going to work exactly the same way moving forward. And you and I both know that it doesn't happen that way. Why is that? Because you can't predict the future. You can't control any of this. And there is no way to reduce the risk. And then, of course, there's blame, exceptions, and excuses. Whatever happened, it's not my fault, right? There's no personal responsibility. And this really is the end result of illusions operating in the trader's thinking all the time. The trader believed he was reducing the risk according to what the charts say, but something happened that wasn't supposed to happen. So there was simply no way to avoid the loss, which is keep more control. So the trader doesn't have to accept the blame himself. In other words, it falls outside of the trader's jurisdiction. And losing traders make this error more often than any other error in their thinking. And most of them don't even know they're doing it. Most of them don't even know that they're blaming something or something else, or making an exception constantly for something that they themselves are doing that result in losses. So to really quickly summarize and then open the floor to some questions, which I'd love it if we could have some questions today. Excuse me. Let me get a hit on my water glass here. Excuse me. Okay, as you can see, all these variations, all these various methods of thinking are interrelated, often involve more than one kind of thinking at a time. And this is why trading can appear to be so confusing for so many traders. The result is virtually no potential for a trader to make consistent gains. It's not possible because his thinking will most likely lead to placing trades for reasons that have little or nothing to do with actual price potential. And what I mean by that is the order flow. If you don't know where the order flow is developing, you can't win. But if your analysis is done in such a way that it convinces you how good you are, and boy, that looks great, and that's an amazing approach, or whatever it is, and you execute for any other reason other than where the order flow is, and that trade wins, that's an accident. You will never repeat that winning behavior ever. That's why guys can put on 1 or 2 weeks of great winning trades and then give it all back plus more in the next 3 to 6 weeks. Can't figure out what they did right to win, think they're doing the right thing. They think they're doing this right thing over and over and over again, and they're not. All they're doing was guessing, but they didn't know they were guessing. So there's no potential for you to make consistent gains because the thinking isn't there. You're not thinking about how the market is structured in order to place my trade against the loser. You're thinking about something else. It's how I feel about the ball game. You know, I lost money 3 days in a row, so I'm due to win today. You're thinking about how this new piece of software that you paid $5,000 for is the real, this is state of the art stuff, and this is going to make me money right now. And I know it's going to work because it's 3 o'clock in the afternoon, and that's when the Nikkei closes. And there's always that little shiver in that market between then and 7 when it opens in Tokyo. So that's what this whole $5,000 piece of software was designed to do, is to find that little shiver in that market. And I can take it every day. But that's got nothing to do with the order flow. See, things like waiting for confirmation, advanced analysis, waiting for the news first, these are all attempts to reduce the risk based on the assumption, the illusion, the misconception, the justification, the evaluation, the blame, the excuse, all that in the first place. It's got nothing to do with how the markets are structured. So all these critical loser thinking processes are the same for anyone facing a failure in any area of his or her life. Our external reality is what it is for us, largely due to how we structure our internal world. If you think the world is out to get you all day, every day, then you are going to see the worst in people all day, every day. And everything's going to be a problem. And no matter what comes along in your world, it's negative. But if you're the kind of person that says, I believe the world is a wonderful place, I'm going to look for the best in everybody all day long, everything that comes along is positive, who's going to have a better day? Now, in the marketplace, if you could change your thinking to fit the market instead of the illusions that people tell you about the market, who's going to have a better set of rate of returns? See, this is why trading can be so difficult for most losing traders. They either don't know they have to change their thinking to succeed. It's about your thinking. It's not your analysis. I do this all day long. I deal with traders all day long. It's not your analysis. It's your thinking that causes you to use that analysis incorrectly. It's not your desire to win. Everybody wants to win. It's not your age, your background, your education, your training, your previous career, how much money you have. None of that has anything to do with finding the right side of the market based on the order flow. Jesse Livermore, the greatest trader that ever lived, said there is no bull or bear side to the market. There's only the right side. He meant where the orders are. And that's how he traded. He said in black and white, this is what I do. He wrote a book about it. The guy made $100 million on one day, back when $100 million was a lot of money. Consistently $30 and $50 million years, year in and year out. all during the 1920s and 30s. You would think people would read what he had to say and apply it. What do you hear now today? Oh no, that's antiquated. That's old. Nobody does that anymore. Livermore lived in a world that was different than ours. Oh, with today's education and training, we can do so much more. Oh my God, computers can outdo what Livermore did anytime. It's all bullshit. Nobody has duplicated Livermore's performance. You know why? Because they don't think like Livermore did. Thinking is where it's at. You want to make the money that's there for you to make? Change your thinking. Most people don't know that's what this problem. Their problem is their thinking. They don't know that. And, or simply refuse to believe they need to change their thinking. That's the other thing. They don't believe they have to change. They just don't believe it. They continue to lose year after year, all the time, getting even more and more market knowledge, market education going through the roof. Some of these guys even teaching courses, right? When in fact, the real problem lies within them. The way you think and the way you behave is determining your percentage profit or loss. If you're not making the money that's there to be made, it's because of the way you think. You're making excuses, expectations. You've got misconceptions, justifications, illusions, misconceptions, evaluations, all kinds of stuff's going on in your head. You don't even know what's going on. And it's causing you to execute in areas where the market potential is low. You don't even know that because you don't know the real rules of the game, which is I have to get on the right side of the order flow or I lose. And there's no way to reduce that risk because nobody knows what the order flow is going to be until the order flow shows up. So if I'm on the wrong side of the order flow, I got to get out. If I'm on the right side of the order flow, I need to sit on my hands and let it work. That's why a guy with no background, no education, no training, didn't even finish high school, can make $50,000 a week trading. That's why. That's how it happens. Doesn't have to have anything to prove. Just needs to be on the right side of the order flow. So now the floor is open to Q&A. Glad to be your host today. Please, let's go ahead and talk about what is important to you guys. By the way, before I forget, I want you guys to buy a copy of my latest book, The Psychology of Trading. And to give you an edge on that, all you got to do is go to my website right here, theliononline.com. It'll say, thank you for buying Psychology of Trading. You click that link, it'll take you to a free sample. It loads right there. You can read, you don't need a Kindle, you don't need anything. It'll load right there in your browser. Read it till it stops. If you like what you see, buy the book. If you don't like what you see, you're welcome to come back and listen to me some other time and find out why it is we're thinking the way we're thinking. Maybe there's something you're still missing. Go to the bonus free material page first. There's all kinds of freebies on there, free PDFs, free information, free videos. And if you want to talk to me about coaching and learning, like I coach and mentor people today. If you're interested in that, we can open a dialogue and find out if that might be a good fit for you. But for right now, you don't need to do that. What you want to do right now is find out if I'm opening something in your thinking. If that's true, we need to start that dialogue sooner rather than later. So I'm going to leave this page up while I still have a few minutes left. David will come in and tell me when it's over. So in between now and then, let's have a look at what the chat line says. What do we got here? Sounds like my mic is touching something. I hope I didn't have audio issues. Stu says my Yugo doesn't work. He still has a Yugo. Danny says, can you use order flow for a longer time frame than day trading? Okay, that's a great question. Here's what you need to understand. The time frame issue doesn't matter. What matters is you have to understand who the loser is and why they execute the way they do. The loser wants to make money when? When does the loser want to make money? Right now. How do you define right now? 80 to 90% of people lose money in this business all day, every day. That's never changed. Since the markets were first invented in the 1850s, and they've kept data about losing accounts and winning accounts, that ratio, 85 to 90% of people lose in this business. Accounts are opened and accounts are closed. 85% of those accounts will close at a net loss. Some big accounts, some little accounts, some big losses, some little losses, but losses nonetheless. And no matter how sophisticated things get, that ratio never changes. That's because the loser thinks the same way today as he did 200 years ago, and he will 500 years in the future from now. It doesn't matter what the time frame is. The loser defines, how do I make money right now? That way he defines it is a time frame of less than a day. These are day traders, people that buy or sell on a 5-minute time frame, 2-minute time frame, 1-minute time frame, 10-minute time frame, 15-minute time frame. They buy or sell based on some whatever it is they're doing. They're going to be flat by the end of the day because that reduces their risk. They're not going to trade overnight because that's too risky. We don't have any control over that. So we're going to reduce the risk by getting out at the end of the day, which means for everybody who executes a buy side order to start his day, he must use a sell side order at the end of the day to get out and be flat. Got it? Which means what? All the buyers that come in have to have a sell order ready to go between now and the end of the day. So what does that look like in price action? If you ever notice the market will open, go higher, then go lower and close unchanged on the day, that's what happened. The order flow was basically day traders getting in and out. Now they're flat. Nothing happened. Order flow is about understanding what people are willing to do with the concept of how do I make money right now? The guy who makes money consistently is on a longer time frame, typically 60 minutes or more, and he's willing to wait to make money because he knows it takes time to make money. So if he buys the low for the week, he might wait 2 weeks. So his position is not coming off. So he's going to sit on this trade for 2 weeks. And then he's going to make whatever distance between his entry and his exit happen to be. He's not concerned about making 1 or 2 cents on a bushel of soybeans. He's interested in making 50 or 80 or 60 cents or $1 a bushel over 3, 4, 5, 8 weeks. Because that's where the order flow is. He is not interested in the loser beating himself up for 2 cents a day. He's interested in the net position the loser keeps taking, which is he always keeps selling into this rising market, which means he's got to keep buying back his loss until forever. So his buying pressure is what's going to keep this market moving higher as he keeps getting out of his losing shorts. So until that happens, until that stops, he stays long. You see what I'm saying? So it's not a time frame that you want to use. The time frame is what's the time frame the market operates on to take the loser and give him satisfaction on his emotional need to make money right now. What is that? In currencies, it's 1 or 2 or 3 minute time frame. There's all these idiots trading Forex that think the way to make money is to try to scalp 0.3 of a point in 10 minutes, 3 minutes. The market's making 2 to 5% move in value over every single 2-3 week period of time. Why wouldn't you buy the low and sell the high if you had the chance and wait, sit on your hands for 3 weeks? Why wouldn't you do that? Well, I'm not going to do that. That's too risky. How's it too risky? Based on what? Based on your need for control. See what I'm saying? So it's not the time frame that you want to use is the time frame that the market is using to separate the losing trader from his money. That's the time frame you want to use. The typical winning trader, the guy in the top 10 to 15% in this business, he's operating on a time frame of 1 hour or more, 2 hour, 3 hour, 4 hour, daily, weekly, monthly trader. Everybody else, they're losing. And that's who pays that guy. Okay. Dee Dee wants to know, what's your opinion of some of the best ways to observe order flow? Okay. Can't give you a 2-cent answer to $1 million problem. Let me give you a story that helps you understand the concept of what you need to look for. JP Morgan, one of the greatest traders ever in history, owned a brokerage firm that was long stocks up until the big crash in 1929. He would go get his shoes shined every Wednesday, all the time, same place, same guy. Goes there with this particular week, sits down, shines his shoes. Guy starts shining his shoes. And he says, Mr. Morgan, me and the rest of my buddies here, a shoe shine guys, we got $40 together. We want you to buy some stocks for us. Mr. Morgan politely declined. He said, well, thank you, boys, but that's not really what I do. But you guys will find someone. Good luck to you. Let me know how it turns out. And he went back to his office. And as he's walking back to his office, he's thinking this. Everybody I know is long. Everybody I know wants to be long. Some of these people have been long for years. The market's at some of the highest prices it's ever been in recorded history. More money has been made in the last 6 years than the entire world has ever seen. There's no end in sight. But I know in order for the market to keep going higher, someone's got to keep putting money into it. They got to keep buying. Now the shoe shine boys want to buy. The shoe shine boys, $40, which back in the 20s was a lot of money. Today's standards, $1,000 account. I'm sure they'd rather take that $1,000 and go gamble it on the horses or drink it because they're shoe shine boys. That's how they think. But now they want to trade in the market. So after the shoe shine boys are in, who's left? Oh my God, there's nobody left to buy the market. There's nobody left on the buy side. They're all in. They're already in. He gets back to his office, makes an announcement to everybody in the office. He says, I don't want this company to own a share of stock. You guys get on the phone with everybody right flipping now and convince these clients they need to be out of the market. We're protecting them. I don't want a share of stock on the books by the end of the day. By Friday, he was about 80% flat. The market crashed. Now today, somebody who does that because of his intuition and insight would be accused of manipulating the market and have to stand in front of these idiot regulators who don't know shit from Shinola to begin with and try to explain, I just had a feeling. I just thought it through. Can't do that. Somebody must have told you. See? Whole thinking is off base. Just wrong. But you can't tell him that. But Morgan said, wait a minute. Something is not right here. I gotta get out. So he did. Market crashes. He looks like a hero. To this day, everybody thinks he's a hero. One of the most evil, black-hearted men that ever trode the planet, J.P. Morgan. Despicable human being if you learn about his life. But he did one thing right? How did he know what the order flow was? He didn't know. Nobody knows. He just recognized that something wasn't right that had to change. The change was inevitable. See, we don't have to know what the markets are going to do to make money in the markets. We need to know the change is the only thing that's permanent. If everybody's in on the long side, sooner or later, they're going to have to use a sell order to get out. I talk about this illustration I talk about this concept in my book, Time Compression, where I talk about how the relationship between who's in and who has to get out eventually puts an imbalance in the market that will cause the market to fluctuate wildly in one direction, and that's very definable. It's called time compression. And when the market is time compressed, it will unleash its fury in a way that will make you cringe. And if you're on the right side, it's all yours. You can learn how to do that. So it's not, what's the best way to observe order flow? You're asking a question that's not quite the right question. The better question is, how do I understand what people are going to do? How do I know when they're ready to do something? How do I know they're going to protect themselves? They're already in, but they got to protect themselves by getting out. When's that more likely to happen? Market's done nothing for 3 weeks, and we got a report coming out tomorrow. Is tomorrow going to be the day when the shorts get their head handed to them? Maybe I need to buy tonight. See what I'm saying? What is it that you're looking for? What are you looking for? You're looking for something that doesn't add up. You see what I'm saying? Bino says, that's what the program trading systems do. They track order flow and make trades based on order flow. Well, that's what, okay. Then let me ask you a question. How come all these trading systems that you're talking about, the program traders, how come they can't outperform the S&P? How come those people that do that high frequency trading, if that's really true, they're tracking order flow, how come they can't make real money? Bill Ackman, how many years has he lost billions of dollars. But he's got state-of-the-art everything, doesn't he? He's going to tell you what time it is. That's what they do. They track order flow. Sure they do. That's why they're not making any money with that knowledge. See what I'm saying? That's what they're telling you. Steve Grove says, been years since I heard you. Glad you're back. Thank you. Everyone is in. Tips from the ignorant, right? Does the book cover time frames and order flow? No, that would be time compression trading. See, I've got several books out. The one that I'm interested, that I think is the way to shorten your learning curve the most, is my latest one. That's the one I want you to look at. If you want to go get a copy of Time Compression, good luck. It's out of print. I've seen it on Amazon for as little as $100. I don't know if you can still get it, but most of them, Wiley. Okay. The reason I self-published my latest book is because Wiley is your typical idiot company that doesn't understand people. They won't listen to the guy who writes the book. They only listen to the people on their board. So when I told them, this is going to be a difficult sell, you need to do certain things to make sure that people like time compression, they didn't listen. So they only let it run for a small production run. That's sold out. They won't reprint it. Now, I can get you a copy and break the law to give it to you, but then do I want that hassle? You know what I mean? The rule, that's... So you have to buy it from somebody who doesn't want their copy or who's willing to give it to you. So that's the best I can do. So I didn't want somebody to be in that position with my latest work. So I self-published it. So that's why it's done this way. But I'm telling you, if we start a relationship together and start working together, you will learn what you need to learn to understand the relationship between time frames and order flow. Promise you. But it's a difficult thing. It's not something that happens all the day. Easily all the time for everyone all the day. It's not as hard. It's not as easy. It's harder than it appears, but it's like anything else. It's a skill you have to learn. You know what I mean? Dino says the institutions, not the hedge funds. What's that? Okay. The systems can potentially put an order in that may be good based on the program and take it back in a millisecond. If not, and keep doing it until it finds a good one. Well, it's high frequency trading, right? And high frequency trading, those guys don't make any money. They don't make any money, more money than anyone else does that tries to beat the system. You know, they're just, look, here's the problem. You can't afford to go to somebody's garage sale and buy an Air Force surplus Cray supercomputer. So you're never going to be able to crunch numbers and have access to the markets the way some of these people do. You don't need to. When a market makes a high print, sooner or later, that will be it. You have to know what to look for so that a high print becomes a sell for you. Because it is going to be a sell sooner or later. Same is true with a low print. Part of understanding how to pull money out of the market is to stop thinking in certainties. It's to start thinking in probabilities. You need to think in terms of probabilities. What is more likely? When you have a systemized approach that is better than chance, then you can win consistently. But you don't even need a system that's better than chance. Okay? All you need is the ability to hold your winners. And I talk about that in the psychology of trading too. If you want to put all this crap aside and start making money tomorrow morning, flip a coin. Pick a market and flip a coin and do it systematically. I'm going to trade euro. I'm going to flip a coin at 10 o'clock in the morning. If it's heads, I'm going to buy. If it's tails, I'm going to sell. And you do that every day at 10 o'clock, a systemized approach. If you did that for 100 days, you'd have 100 coin flips. And according to statistical probability, you will have 49 heads or tails and 51 tails or heads. So let's suppose you had 49 heads and you went long on the heads and 51 tails and you went short on the tails, but you managed to hold your winners for $2 against every loser that you lost $1 on. So out of 100 trades, you lost $51 on your losers, but you made 49 times 2, which is 98. So 98 minus 51 is 47. So after 100 trades, you would have made $47. So let's make this really easy. Let's call that percent. You're going to risk 1% on your equity and flip a coin in the euro every day at 10 o'clock. And you're going to risk 1% a day. At the end of 100 days, if you had 49-51 ratio, and you held your winners for 2%, and you gave back 1% on your losers, at the end of the day, after it's all said and done, after 100 trades, you should have relatively close to 47% gain on your account. I mean, what are you going to do? Argue with the numbers? I know people that do that. They took every book in their library, every book. Market Masters, Hedge Fund Masters, Never Be Lied to Again, Volume and Open Interest, Mind Over Markets. Well, let's not forget the big ones. How to Make Money in Commodity, The New Market Wizards, The Inner Voice of Trading, the big one by Koppel, The Tao of Trading. And of course, let's not forget His Holiness Mark Douglas, The Disciplined Trader. They took all those books, threw them out, and flipped a coin every day, making money every quarter. What are you going to do? Argue with that? Why is that? Because it's not about knowledge and market study. It's about getting on probabilities. Getting on the right side of the order flow can help you get better probabilities. But even if you just threw all this out the window and went with just probabilities, there's a way to create a winning approach using just probabilities. And you're welcome to look for it. You know what I mean? All right. So anyway, I'm running out of time here. Dave is going to hop in a minute and yell at me because the next guy's getting ready to go. So I'm sorry. I got to go, guys. Listen, thank you for having me. My pleasure as always. I hope I'm invited back. A lot of times I get hate mail after this, but I hope I'm invited back. You guys consider me your friend in the business. I'm here to help. Just go to my website, theliononline.com, and get a copy of the book by looking through the pages there. There's a lot of free stuff. You want to start a dialogue, you want to learn more, you want to talk about things like coaching, mentoring, or private education, or other things like that. You're welcome to open that door. Just join my mailing list or fill out the contact me form and say, hey, give me a call, put your number in there, and we'll talk in the next couple of days. Don't forget Memorial Day here in the States this weekend. So I'll be gone, but next Tuesday, Wednesday, we can pick up from there if you like.
All right. Thanks, Jason.
Are we good? Are we good?
Hey, you're definitely welcome back anytime. So
hey, dude, did I run long? I don't have a clock here. I'm thinking I'm running long. It says 4:58.
Just a couple minutes.